All right. All right. Hello, good people. It's amazing. It's a great day. I am so happy to bring this episode of the Prosperity for Posterity podcast to you today. This topic is timely. So get your pen and paper because it's tax season almost. We're after the holidays, we're going into the tax season already. And these tips, we're talking today on tax tips for 2022 tax filing. And I have no other person than my own brother. This is not, brother for the sake of saying brother. This is my blood brother, a brother from the same father and same mother. So I'm excited to have him join us today. Egbon, you're welcome, sir.
All right, nice meeting you. You're doing a great job, and
Well, thank
I'm
you.
happy, so happy to be part of this program.
Excellent. Thank you so much for coming.
All right.
So, folks, without further ado, I'm going to do a formal introduction of Mr. Ajanaku here, and then he will take it on from there. Tell us, outside of this formal description, who is Mr. James Ajanaku? All right. Mr. OLALEKAN James Ajanaku is a senior consultant at oj.konsult Financial Services. This is a tax and financial consultation firm with over 10 years of experience. Their services to their clients include personal and business tax filing, personal and business tax filing, yes, accounting services, which is bookkeeping and accounting, payroll services, business advisory services, business registration, and sourcing working capital for small businesses. The office address is at 10333 Arwin Drive, Suite 677, Houston, Texas 77036. And their phone number is 281 901 2298. Their email oj.konsult at yahoo.com and at info@oj.konsult.com, and their website is www.ojconsult.com. Welcome, sir, one more time. It's good to
Welcome.
have you on the show
So beautiful.
today.
I'm doing
Excellent.
great.
So that is the formal introduction of my brother, Mr. James Ajanaku. So let's my audience meet you, sir. Who is James Ajanaku?
Okay, yeah, good afternoon. Well, it's afternoon right here in Houston. So, and I can tell you it's sunny around here. It's a beautiful day, a little cold. And I'm sure wherever you are, you're also enjoying United States weather.
Awesome.
James Ajanaku is an accountant and a bookkeeper and a tax representative with the IRS. We've done this, we've been doing this for about 10 years. We have clientele of well over 600, 700. I mean, close to 700 clients right now and counting. So we've our clients have always one thing they rely on us is information. They rely on very updated information with the IRS or with the government agencies. So we've always been of good service to our clients, and that's why referral is what we depend on so much solely. And people always love referring. If we do a good service for one brings in two, and two brings in
Mm,
four, and on and on. And
mm,
that's how we've been growing. Our target really as consultancy practice or firm is to target small businesses, small businesses. So, and that has been our niche around here. And right here in Houston, we have our clients, all over Houston and Texas generally. And we have clients all over the United States also, because we service clients well over 50, I mean, the entire states in the US, about 52 states in the US. And we have so many clients all over the place, not only in Houston. So we thank God for where we are, and we believe today we're going to be able to inform you and give you very good information that will help you in your tax filing in the new year. In the meantime, I want to say Merry Christmas to our
Yes.
Christian folks, uh, and have a very, very wonderful new year ahead. Yeah.
Awesome. Thank you so much. I said we want to meet you.
Okay.
All you've given us again is former Mr. James Ajanaku. So
Okay.
can you tell us one thing that I've noticed with you
Okay.
is, that, yeah, one thing with that we picked up, any of his children, that
Mhm.
we picked up from him is dancing.
Okay. Okay. Yeah. Yeah.
And I know you dance a lot, and
Yeah.
you dance a lot. So can you tell us what would you say as maybe like something that's where you picked that from? I may have hinted at that, but how did you get to be very good at dancing, basically?
Okay. Yeah, I'm happy you brought that up because, well, personally, I love dancing. And
Yeah.
like you rightly mentioned, or let it cut out, I got that from my dad. I mean, it's a wonderful dancer.
Yeah.
And I remember on a, you know, traditional wedding day,
Mm-hmm.
my dad danced so well.
Yeah.
It's still, if we look at that video today, we still we still
I
see.
saw that. Uh-huh.
So that's one gift that kind of got, through my dad, and I love dancing. And apart from that, I mean, James Ajanaku is a family man, married with 4 kids, and we try to, do a lot that we can do, within the family, and personally too, I love reading. I love reading. And I love eating very, very good food, So, and I love taking care of my body, so I stay healthy,
Awesome.
So generally, that's what it is. But going back to dancing, do I still dance like I used to? Uh, Now, with I'm not as young as I used to be. I still dance very well, but I do a lot of shaking now.
Yeah.
Down below dancing, you know, yeah,
I remember that video
that's right.
with Daddy, right? And that
Uh,
was my goal. Like on my wedding day, Daddy must dance like this. But we
uh,
thank God
yeah,
it happened the way it happened.
yeah.
If one thing that I missed on that day was him being
Mhm,
able to
mhm.
be there to
Yeah,
dance. But we thank
yeah,
God,
yeah,
it's all good. It's all
yeah.
good.
God be the glory.
Yes. By the way, our dad is of blessed memory now,
Mhm.
and we thank
Right.
God for the legacy,
Mhm.
that he has left with us. So,
Right.
alrighty. So we now come back to business now,
Okay.
talking about tax tips for this coming year for the tax filing. So,
Okay.
sir, can you tell us three major changes that people can expect when filing their personal tax in 2022?
Okay. Now, this is good news, and I'm so excited to discuss this because before now, what we usually discuss is increases in taxes.
Hmm.
When you hear tax season, people's hearts always jump up. I mean, what is it again? The government has come to
Mm,
take our money again. They want to add to our taxes. They're going to
mm,
increase our taxes. So, but this time around, because of the inflation that is going on in the country, the government has been very, very sensitive to the needs of the people, and such, they've been whatever that is happening right now. The government is trying to put money back in people's pocket,
mm.
and maybe, I mean, just for our information to let us know, the tax code of this country is very, very complex. I must tell you that, very, very complex. I mean, we have over 34,000 pages, 34,000 pages
Wow.
of tax code, in America. And since 20,000, I mean 2001, there has been more than 4,500 changes in tax code
Wow.
just between 2001 and date.
Wow.
There has been over 4,500 changes in tax code, and I can tell you also, many taxpayers, they lose out on millions every year,
Mm,
just maybe by filing wrongly, or by not filing their taxes, properly, or not just avoiding filing taxes. And also, there's an estimated 44% of Americans that do not pay tax at all. About
Wow.
44%, 44%, almost half of the nation, they don't pay tax at
Mm.
all. So that's to tell you that this is close to the heart of the government alone. And but like I said, there are three items. There are so many changes this year, but I'll just narrow it down to the basics that I believe affects almost everybody,
Okay.
almost everybody, because there are some that affects the very, very rich, the billionaires, and then some into specific business or trades like farming, like some specialized trades here and there, but not many people are in that bracket. So I want to narrow it down to where what affects majority, over 90% of
Okay.
the population of this country. And so I'm going to be discussing three of that. And but let me tell you also, I'm doing this and I'm happy doing it because I know this is going to make our people happy, as many that want to file tax this coming year.
Hmm.
Really, really happy because these changes are bringing money and putting it back in your pocket. Uh,
Awesome.
Number one of it is what we call standard deductions. There are some changes to the standard deductions this year. Now, let me start by discussing or explaining what is standard deductions.
Hmm.
Now, standard deductions is an incentive, is something like a tax break that the government gives for everyone. It's available, for everyone, but it's what the government takes out of your earned income, of your earnings. And
Hmm.
then after taking out the standard deduction, then the rest is what they tax. They tax the rest. So, and like I said, it cuts across everyone. So that's what we call standard deductions. Now, there's always also what we call itemized deductions. Now, it's not everybody that's able to itemize. Itemized deductions means you are able to bring in some items, for deductions, and then you weigh it side by side with standard deductions. Now, if you have more on itemized deductions, then you go with the itemized deductions because that will give you more tax break. But if you have more on the standard deduction, you just stay there and ignore the itemized deductions. Now, itemized deductions are for people that have some items that are relevant, for deductions. Items like if you're a homeowner, for instance, and you have a mortgage interest on your home, and you have a property tax, then you can take advantage of reporting that. There's a form called 1098 form that your mortgage company will be sending to you. They don't send it to you; you can pull it up from your account on the website of
Hmm.
your lending company. Now, once you get that, look out for those two items: mortgage interest, property tax, and those are the items you need on that. Now, also you can, take out if you're a good donor, if you donate money a lot to agencies that are accredited by the IRS.
Hmm.
Yeah, agencies. There's some agencies, 501c status agencies like churches, mosques, or all these non-governmental agencies like Goodwill and all that. Now, or Red Cross, you are able to, if you have a proof of that, very important,
Hmm.
very important. Make sure you have your proof, and then you can take advantage of that deductions. I'm talking of itemized deductions.
Itemized.
Now,
Yeah.
on another item on your itemized deductions is you're able to, take out some, if you have medical expenses that are really, really substantial. In the COVID era that we're in right now, a lot of people are really taking, spending a lot, trying to
Hmm.
save and keep healthy. So if people maybe fall sick and they have to spend a lot of money out of pocket, then whatever they spend and they can report it, you can help reduce or increase the itemized deductions amount
Hmm.
and then give them an advantage over the standard deductions.
Okay.
Now, the changes, let me now come back to the changes on the standard deductions. Now, for single married filing separately, it went up by $400.
Hmm.
Now the standard deductions is 12,000 naira and $50. And what that means is that now your deductions has been increased by about $400. Now about $400. Like I said, That's money back in your pocket. That $400 will not be taxed in addition to the 12,650 that used to be, or 550 that used to be there. Okay, and then if you're married, filing joint, filing marriage joint with your spouse, you're able to deduct $25,900. $25,900. That's an increase of about $800 if
Okay.
you're married filing joint. That's $800 back in your pocket. And then for head of household, if you're head of household, that means you have dependents and all that.
Mm-hmm.
That's $19,400. That's an increase of about $600 money
Oh,
back in your pocket. So these are the little changes or increases that has come upon the standard deductions. Now talking about the standard deductions also. Um, Now for those itemized deductions, like I said, includes all those items that I mentioned earlier.
mm-hmm.
Unfortunately, until about 3 or 4 years ago, uh, now it used to be possible that you're able to deduct some other items like your cell phone, your uh, commute expenses, and all those expenses, your out-of-pocket expenses. But
Mm.
now all those things are no more under the itemized deductions. So
Oh,
except
wow.
you have all those major items, and I said contribution to non-governmental, or you have the home where you are claiming your tax, property tax, and the mortgage interest. It might not be worth itemizing, so you might just
Okay.
have to stick with your standard deductions. So
Mm.
those are the changes when it comes to standard deductions. But there are some states that still qualify for itemized deductions, and I need to mention that some
Okay.
states, I know New York is one of them, some other states like that. So look out for your state. That it's not all states that do state taxes, and it's not all states that also qualify for state tax deductions, itemized deductions. But if your state qualifies, go ahead and itemize under the state. It will really help to reduce your taxable income and thereby put money back in your pocket.
Awesome.
Now, the second, that's one. Standard deductions is one
Yeah.
big item. And the second one is the tax bracket also has been adjusted a little bit. You know,
Mm.
this also I tell you is a good news because most people before now they just are weary to add additional hours when they hit a bracket. They're weary to add additional hours, maybe take overtime or
Mm.
take more hours because they're afraid that okay, if I do this additional job, hours, then they're going to pay me a little more, and that little more will just go to the hours because
Right.
go beyond your tax bracket, you go into a new tax rate.
Mm.
The minimum tax rate in America is 10%, and the highest rate is 37%. So you are between 10% and 37%, depending on your bracket. And what they've done is for the lowest, which is 10%, they've increased it and expanded by about $400. And what that means, for instance, is if before now, if your bracket is $10,750, for instance, now they've increased it by $400. So that
Mm.
means if you work a little more additional, like $400, you are still within the old bracket.
The whole
You will not
bracket.
be taxed in the new rate. So you are still
Wow.
within the 10%, and we will not go beyond that. And good news for those that are for high earners, those that earn, huge income, the highest bracket, which is 37%. Uh,
Mm-hmm.
they've increased theirs by $20,000,
Oh,
by
wow.
$20,000. So don't be afraid if you got some more raise on your income, uh, still within 20,000, you will still keep your tax bracket. You will not be taxed higher than what you should be taxed. So, and that's really good news because most people, like I said, they just cut off. Once they know they are at that bracket, they cut off.
Yeah.
That's how you see some people just take some holidays off work and they will resume back in January once they hit that bracket. So
Wow.
don't be afraid anymore because now you have this little increase on your bracket that keeps you where you are, even though you have earned a little more.
Mm.
That's a very good advantage. And the third one is the earned income credit. Earned income credit. Now, earned income credit pertains to everyone. It pertains to everyone, actually, as long as you have an earned income. And not only for those that have W-2 income, even
Okay.
if you're self-employed, you can still enjoy earned income tax credit. Now, that's very good, actually, for those that have children.
Mm.
If you have children, this is good news for you, I tell you, because now the government has increased the credit a little bit. For one kid, it used to be 3,723. Now
Mm.
increased it to $3,618. They've increased it a little bit. And for two kids, if you have two kids, then you are guaranteed of earned income credit of 6,000. I mean, see, five. It used to be. I'm sorry. It used to be 3,006 for one kid. Let me reverse back. For one kid, it used to be 3,618, $3,618. Now they've increased it to 3,723.
Okay.
Yeah, to 3,723. And for two kids, it used to be 5,980. Now they've increased it to 6,164 for two
Okay.
kids. And for three kids, they've increased it from 6,758 to 6,935. $6,935. So those are the changes for the earned income credit. And like I said, it's not necessary that it has to be W-2 income alone. Even if you are self-employed, you can,
Hmm.
as long as you have an earned income, you can benefit from your earned income tax credit.
Excellent.
Those are the major three, and I think affects the majority of taxpayers
Awesome.
here in Nigeria.
Awesome.
Mhm.
So, what this is personal. I'm going to chip in a personal question here.
Okay.
Now, for those that are more, investing in crypto, earning interest, I mean, earning profits and all that, like forex trading and all of that.
Okay.
How does the day benefit in any of this?
Okay. Now those are what we call additional income.
Okay.
Like self-employed income. It's a form of self-employment. That,
Yeah.
yeah. So it's called substitute income or additional income.
Yeah.
Now, if you have that, of course, you're going to be getting 1099. From your transaction from your trading company.
Hmm.
So once you get that, you are required to report that. Of course, that will add to your income because it's also
Right.
earned income. So it will add to your income, and of course, that whatever that brings, it will give you an advantage. So, and that's where the tax bracket. That's where it really comes in, because now for the lowest bracket, the increment is $400. So if you have like a stock trading that brings you additional $400 for
Hmm.
4 years, no worries. Yeah, you're good. You're taken care of. So your bracket does not change. Your percentage still
Yeah.
remains 10%. And for high earners, up to $20,000. So
Mm.
you see now this bracket really benefits people like that and have additional income or supplemental income like that. Mm,
Awesome.
mm,
Awesome.
yeah.
All right, that's good. Folks, I hope you're taking notes. These are really, really important information
Mm,
that you can ask your tax advisors, or,
mm.
if you know that possibly you don't have one now, you can definitely reach out to my brother here with oj.konsult so they can take good care of you. Make sure you're not leaving any money on the table. Okay. So we'll go to the next question. It
Okay.
says, I have here common mistakes people make when filing personal taxes. So, what are those and how may we, avoid them?
Oh, okay, great. Now this is very interesting because I tell you, when people want to file their taxes, they're excited. Their goal is always after what they could get.
Hmm.
What's my refund? Who gives me the highest refund? That's what people go for.
Hmm.
But usually, that shouldn't be the drive. The drive should be who files my tax best. That should be your goal. If you file your tax the right way, don't worry, you'll get the correct refund. It's not going to be a problem. But now things to watch out. When you're filing your personal tax. Number one, avoid using your last paycheck as your proof of earnings when you're filing your tax. That has put many
Mm.
people in trouble. You see, because I found out that many people, they just rush in immediately the tax season opens, maybe towards the end of January, somewhere there. You see them just rushing. Have you got your W-2? They say no, but I have my last paycheck.
Oh,
Now the last paycheck does not mean, well, that's what will be on your W-2. That might not be your final numbers. So
mm.
don't be in a hurry. I mean, it's good to file early. It's very good to file early, before the whole system get roughened. It's good, but you see, it's always good to take your time, get all your papers together,
Mm.
and and saying putting your papers together, make sure you don't miss out anything. What I found out is most people, they just rush to get one W-2 or two, or two, and then they just rush to town. They want to file, but they forgot that they probably work somewhere 1099 with one company somewhere as a service provider or consultant,
Wow.
and then that one has not come in the mail because not everybody sends in their W-2s or 1099 early. So
Mm.
make sure you get everything in. Once everything is complete, that's when you should file your tax. That's one major item or major thing that you need to pay attention to. Number two, make sure you pay attention to how your tax filing is being processed. Now, this year, many people came to my office and they're trying to file an amendment on their taxes because the IRS just hit them with some extra charges. And why? Because some things were filed on their taxes or tax returns that they didn't even know about. Some,
Wow.
some in some cases, some people file, or some their tax preparers just put on their system that they have a Schedule C, which is self-employment, and they don't have self-employment. So, but
Wow.
the tax preparer just put that there for them, just to help them make some claims that will help them increase their refunds because
Mm.
with the self-employment or Schedule C, they are able to file like laws on those businesses, and then
Mm-hmm.
laws will go ahead and reduce the taxable income and then bump up their refund. I mean, with that, you are really treading on a very dangerous track
Wow.
because if you don't have a business and then somebody puts it on your tax returns, that's a violation of the law.
Right.
They're trying to steal from the
From
IRS,
the
and
government.
they're going to come after you. So avoid that. And how you avoid that is ask questions. When the tax preparer finishes your tax returns, ask questions. What and what? If he says, "Oh, you're getting 5,000 or you're getting 6 or 10,000," why? What did you do? How did that come about? $10,000. Don't just say, "Oh yeah, good, 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 congratulations. I got
Mm.
go to town." So
Mm.
you need to be very careful. And
Mm.
then also very important, make sure you don't file other people's children on your tax returns. Do
Ooh.
that a lot. I see people
Wow.
do that a lot, and maybe trying to help some family members, especially that don't live with them, because the rule of dependency is that whoever you put on your tax returns as a dependent must not, one of the rules is that the person must have lived with you for at least 6 months and one day. More than
Mm.
6 months. That's how you are now qualified to claim that child.
Okay.
So if that child does not live with you, or you don't have the custody and you don't have the care over that
Mm-hmm.
child in terms of expenses, taking care of the child, like daycare and all those school expenses,
Yeah.
don't do it, because RS right now, they're really really aggressive going after people that just trade children, moving children all around.
Mm.
Avoid that. That's one no that you should avoid. And another thing is, if you're filing your tax, make sure you have everything reported. Especially if you have business. Don't just assume numbers. Do your bookkeeping very well,
Mm.
so that if you are filing Schedule C, make sure everything is well reported. Your mileage. Don't just put a number. Make sure you have your mileage log, especially
Mm.
on your Schedule C. If you're going to put mileage, make sure, because IRS is actually going after people that just put some numbers so they
Mm.
can just get it, like a loss on their tax, their Schedule C, and then get more refund. So be careful. Make sure everything is well accounted for, and you have proof for everything you put on your tax returns.
Exactly.
IRS could come asking questions. I think those are major of the items that I think mistakes or and people should avoid when they're filing their taxes.
Awesome. Awesome. Wow. That is amazing. And
Yeah,
of course, I guess we can add to it, not using good tax folks to
yeah,
to help them file their taxes, or maybe it's those that are doing it themselves and
mm,
do not have enough information or enough knowledge about these things.
yeah,
All
that's
right. Excellent. Thank you so much for those highlighting those mistakes for us.
right.
Now, what are the tax filing pitfalls we are to watch out for in order to avoid IRS audit? I think you might have touched on a few of them.
Right.
Is there any other?
Okay, yeah, yeah. There's still. I'll just mention one or two more. And now on the itemized deductions, what I found out that most people just assume, oh, this one area where I can just put some numbers and just get some money out. No, don't just put anything,
Hmm.
especially on your itemized deductions, except you have the document to back it up. For instance, if you did not donate money to your church, or if you don't have proof that you did. Most people they
Hmm.
don't do cash offerings in churches, for instance, or a mosque. They just go in there and throw in the money, throw in $100, $500 cash, $1,000 cash. Those are money that are not reported anywhere. They're just under miscellaneous in the church.
Right.
So the church does not know you did anything. So make sure whatever you give as donation, you have a proof of it. If you can track it, actually, if it's possible, you give your donation with check would be great. Otherwise, do Zelle. That way,
Hmm.
everything posts to your checking account and
Right.
have it all reported. And at the end of the year, you have the report. And also, the church can even give you what we call contribution report at the end
Hmm.
of the year. And apart from that, too, actually, the medical aspect. I noticed, because for medical, to claim medical expenses, it has to be substantial.
Hmm.
People should avoid putting medical if they don't have medical expenses. Avoid it
Hmm.
because now you find out that people, if you don't put something up to like 50,000, 70, 100,000, it might
Wow.
not get you anything. So people might be tempted to just put a number so they can just get something. Avoid it.
Hmm.
Avoid that. It's very, 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 very risky. It can pump an audit, and also be consistent. I noticed some people just so they can get more refund. You see
Hmm.
husband and wife that are happily married, living together. They just come and say, honey, should we just split the two? Maybe they have 4 children. Let's just split the children. You have two, I have two, and then
Hmm.
file it of household individually. Don't do,
Wow.
don't do it. That is a no-no with the IRS, and I'll tell you
Hmm.
why. Now, when you say you're doing head of household, part of the definition for head of household to qualify is that you're single, number one, or you're divorced, or you're like a widowed and you don't have a spouse. But you see, if a couple comes in and they say, oh, and they are married and they are telling to split, that's a red flag with the IRS. And this how IRS knows if you are not consistent. And then if you
Hmm.
do join this year, for instance, and next year you do filing you do head of household.
Universal.
Another year you do head of house, also single again. Another year head of household, you
Hmm.
fell into IRS trap. So you want to avoid that. And also, when you are doing head of household, make sure, like I said, make sure. Another error that most people don't notice or they don't
Hmm.
come to is they're living together and they're using the same address and they're saying they're filing head of household
Universal.
with the same
Ooh.
address. That's how IRS catches some people. How come are you living together and you are doing head of household and then you are happily married? That's really wrong. But it's
Hmm.
possible also. It's possible. Let me quickly explain that. It's possible that you are living together and then you want to file separately. It's possible.
Hmm.
There's nothing that says this is a free will economy. You are free to do what you want to do. But when you're doing that, you don't do head of household.
Head
You
of household.
married filing separately. It's
Mm.
possible. It's okay to file married filing separate that way, but of course, that comes with a penalty because you're going to lose the credit that comes with marriage. You're going to lose your marital credit. You're going to lose a lot of money because there won't be refund. So if you must file separately, keep it married filing separate. But you must have a genuine reason why you do that because
Mm.
you're going to lose money, but you'll be happy doing it because you have a genuine reason why
Right.
you're doing that. Otherwise, it's always good to file marriage joint.
Okay.
That way you keep your head safe. Yeah.
Okay. So, what are the cases where people have to file separately even when they are married?
Okay, there are instances. For instance, if this is January coming, some W-2s will come early, some will not come until maybe March, April.
Mm-hmm.
For instance, if the husband has his own W-2, everything is in January, he might say, honey, we need money. I need to claim back my federal withholding. I mean,
Mm-hmm.
I gave it out, I need to get it back, or we need to get a credit on the children. Okay,
Mm-hmm.
now that's how they can now decide, let me go ahead and file. Then when her own W-2 comes, maybe March or April, then she can go ahead and file. So those are
Okay.
legitimate reasons. Or if they live separately, they are married happily, but they live separately because of
Okay.
job, for instance. If somebody works in New York, maybe the husband works in New York and the wife works in Houston, they are happily married. They might
Mm-hmm.
have two homes, because in New York, the man has a home there where he stays, and in
Mm-hmm.
Houston, the wife has a home where she stays. That's their joint home in Houston, though. But in New York, the guy has maybe a condo there where he lives, so he can file his own separately using that address in New York, and the wife can file her own separately using the address in Houston. So those are instances where there will be genuine reasons why people will file separately,
Oh,
although
okay.
they are happily married.
Oh, okay.
Yeah,
But in that instance where they are living in different state, can they still do joint filing
you can still do
and
joint.
using? Okay.
Yeah, and then they will agree on what address. They will agree on
Okay.
a common address where
Yeah.
they will use. Actually, if what took you to Houston, I mean to New York, for instance, is a temporal, it's
It's
just job
temporary.
transfer. That's
Mm-hmm.
a temporal arrangement.
Mm-hmm.
So when the wife and the children are, looks like a home, like the family home. So then that will just be your address, your main address where you receive your correspondence. You receive That's where you live really.
Yeah.
Home is just for transfer or for work, something
Mm-hmm.
like that. Hmm.
Okay, that's awesome. Excellent. So this has been amazing tips for personal and now going into businesses.
Okay.
For businesses, I know you've touched on a few things on, as a business owner, like an individual business owner. Now, going into tax advantages, what is the difference? What are the tax advantages of owning an S corp business over C corp business? And if before you go into that, tell us what is an S corp, what is a C corp, what's the difference?
Okay. Okay. I'll do that. Okay. Now they are both corporations. That's what we call incorporation, INC. Incorporation. That's limited liability company that
Mhm.
have corporation status. Now, for companies like that, if you don't ask for a change of or adoption of an S corp status, automatically you are a C corp. So, in other words, when you register a company, you register it and it comes as a C corp. Now, at the point when you are now filing or claiming trying to get your EIN, your employer identification number,
Mhm.
and now there's a question there. They will ask if you want to opt for an S corp status or you want
Mhm.
to remain as a C corp. Now, if at the point of uh, asking or requesting for your EIN, you indicated that you opt for an S corp status. Now, automatically, when you say you're an S corp, that brings you down, or it now brings you to a status of like a partnership.
Okay.
That Yeah, it brings you up to the status of a partnership. And why I said that is that the members of that company, and that's the difference between S corp and C corp. Under S corp, whatever you make in the company, profit or loss, is not taxed under the company. Is not taxed under the company. Each member of the company or owner of the company, they will have their uh, what we call K1 report of whatever it is, profit or loss,
Mm-hmm.
reported to them. And that's what they will take to their personal taxes to file as additional income or supplemental income on their or investment income on their personal tax returns. So
Mm-hmm.
they're going to be getting what we call K1. And this is the advantage. This is why people opt for that. Now, most businesses in their first 3 to 5 years of trying to find their feet, they run into losses. They run a lot of expenses and all that that could accumulate into some form of losses. Now, losses, if you report losses on your personal tax returns,
Mm-hmm.
the K1, it helps reduce your taxable income and it brings you to a lower tax bracket. So that helps reduce what you pay as taxes. And of course, bumps up your refunds a little bit. So that's the advantage. And that's why most people opt for that, So, but under C Corp, C Corp is a standalone. You have to file the company by itself. You cannot bring that or whatever you make in there into the business, other than bring in the dividend. What you will be bringing in will be the dividend that was distributed under your company or under your C corp. So that's the major difference. And then the major difference is also the advantage. If the
Mm-hmm.
company will be giving you a loss advantage, of course, it will be nice to just opt for an S corp status. But S corp status is very, very strict because IRS knows that they are giving out something, so they want you have to be diligent. If you
Right.
file your tax late as an S corp, you're going to be heavily penalized.
Wow.
Heavily penalized. So when you're an S corp, you don't file your tax late. Otherwise they will penalize each of the members of the S corp. So you make sure you file early on time, and then make sure whatever it is that comes in terms of K1 to you, make sure you report it on your tax returns.
Mm-hmm.
Profit or loss. But usually, the advantage comes with the loss. Yeah.
Mm.
Mhm.
Excellent.
Mhm.
Excellent.
That's right.
All right. I think that's about it. Is there any other items that you want to bring up that I didn't touch as a final word for the people as they go into the tax season to begin putting in their taxes for
Oh,
2021?
okay. Now, thank you for bringing that up because it will be a good time to mention this. That now, when you're filing your tax in 2021, I mean 2022 now, when you're filing, make sure uh, you get the best in terms of a professional to help you file your tax, because
Yeah.
that's the starting point. Don't just go to people because they say, oh, it gives high refund. Oh, how much did you get? Oh, X amount. Good. I want that too. Don't do that.
Mm.
Don't do that. Make sure you do your due diligence. Who is this individual? What's the experience like? Something like that. And
Mm.
then do everything possible to avoid IRS audit, because I tell you, IRS, they can go back years, 5 years, 6 years of your past filings, and
Right.
pull it up, and it can still haunt. So don't. I mean, if you say, "Oh yeah, I already got the refund," oh, they forgot about it. Others, they don't forget when they sample you and they get you, and then you're part
Mm.
of the sample for audit. I mean, they're going to come back, and you can imagine if they come after 3 years. That means there will be, and you have a penalty of, I mean, you have a payment to make. There will be late payment penalty of
Right.
3 years. Imagine 3 years. That's how
Mm.
you get people who say, "Oh, I owe 50,000, I owe 80,000, I owe 100,000."
Wow.
All of these back taxes or the age of the outstanding. So
Hmm.
you need to really pay attention, and also make sure you put in, when you're filing your tax, it's always good to do direct deposit, and so that your refund does not get delayed. Make sure you check your routing number and account number that you give your tax preparer. It's very
Mm.
important. I've seen cases where people just don't pay attention to that. They just give in something, and then if you put in the wrong numbers, of course, it's going to delay your refund. I mean, normally refunds should come in 2 weeks or thereabout, but or less than that, actually at the early stage. Now, if you put in the wrong number, then IRS will need to first cancel the first payment and then rewrite.
Mm.
We send you a check this time, and then you're talking of about a month or even more. So it can
Wow.
delay your refund. And also make sure, I mentioned this earlier, make sure your paperwork are complete before you head
You
on to your
start.
tax preparer. Don't rush. Don't rush at all. Take your time.
Mm.
But if you have everything ready, file early. It's always good to file early.
Awesome.
That's
Awesome.
mhm.
Excellent. You've been, I think, since you started your practice, we've been with you.
That's right.
For our personal and our business services, the tax and the financial services. So,
Right.
and we've been happy with your handling. So, I
Mhm.
want to give opportunity to my listeners and viewers to enjoy what we enjoy. So,
Mhm.
if they want to work with you,
That's right.
how can they, I think I have your website and all of that scrolling on the screen, but for
Mhm.
those that are going to be on the podcast, how can they get in contact with you to to have you as a consultant for their business and for their personal taxes and financial services?
Oh, okay, great. And before I give that information, I want to suggest this that now, well, people, I mean, we don't charge for advisory services. If you just call to say, oh,
Good.
I want to check it out, I do that, and I do that as a courtesy. So, usually, if anyone will call and he says from this podcast, I'm going to be giving you a free estimate. So, in
Awesome.
other words, you don't have to file with me unless you're happy with me. So I can,
Wow.
you can check me out, and I make sure give you the best. If you're happy, then we complete it for you. Otherwise, you will not be charged a dime. And yeah,
Wow.
but that's one thing I can give as an offer right here for those that are coming in through this podcast. Now, if you're
Awesome.
reaching us, our phone number is 281-901-2298. I'll repeat that,
Excellent.
281-901-2298. And then our email is oj.consult, K for consult. In other words, O space J, I mean, no space now. OJKONSULT, oj.consult@yahoo.com. That's our email. And our
Excellent.
website is www.ojconsult.com. If you go on there, you see all our
All
services,
the information.
all information, and then we promise you the best, and you'll be really, really happy. Our customers
Awesome.
always leave our office happy, and we want you to be one of them.
Excellent. That's amazing. Thank you so much. Now, before you go,
Mm.
I usually try to have this question to all my guests, and the question is about legacy.
Okay.
So, as a person of faith and all of that, and you're a family man, you're, God fearing man and all that, what would you say you would love your legacy to be as a person?
Oh, okay. Now, what? I try to leave that right now. I try to make sure somebody rises through me.
Hmm.
I try to do that, in my little way, and I got this from the Bible actually. You know,
Yeah.
I shared it with someone recently that Jesus is very, very careful how he runs his ministry.
Hmm.
He picks one man at a time, and when he starts with that man, he finishes it.
Hmm.
He holds a woman, for instance, at the well, stays on there until finishes that project. So my legacy really is maybe after I'm gone, I want to be able to see people who will say, "Oh, by the grace of God, through this man, I am what I am by the grace of God." So
Awesome.
yeah, it might be a little input into their life, maybe advisory services, might just be some little financial support here and there, or just ensuring that you're a mentor, in their life. I have a brother, a family actually, approached me recently. They came to my office and met my wife and I and said, "Oh, we would love you to be our mentor." He's a
Wow.
man married with about, I think, 3 kids, and he said,
Hmm.
"He would love me to mentor him." And that gets me thinking. That means he probably noticed something in me.
What did he see? Yeah.
He
Hmm.
probably saw something, and I will want to kind of mirror his the pattern his life or his family, after that. So that's what I want as a legacy, that people after
Mm,
me will say, yeah, this man poured this into my life, and
yeah.
I'm the beneficiary of it. I love that.
Awesome. Awesome. Thank you so very much. So, folks, here you have it. You have your tax tips so that you don't leave any money on the table at the tax season coming up. And you've had one or two things that you definitely can use. And you have my brother here at your, fingertips. You can just call him for a consultation. Thank you for that offer. Thank you so much. So you can call him. You can go on his website, email him. That is his information. Scrolling for those that are, yeah, viewing the video. If you don't have that video, it's going to be in the description of the podcast. You can definitely reach out to him, to for his consultation. He had already said if you say you're from this podcast, that the Prosperity for Posterity podcast, that you will have free consultation with him. So that's amazing. Thank you so much, sir,
Thank
for
you.
coming. We really, really appreciate this. Have a wonderful day. My regards to everybody.
So thank
You're
you so much,
welcome.
Amy. You're doing a great job. We are
Thank
really
you.
proud of
Thank you so much.
you. All right. Thank
God
God.
bless.
Okay, you too. Thank you. Bye.